Okay, very good morning to everybody as we start this webinar session. So today we are doing something special. We're basically broadcasting this session live to YouTube just as a special test of our new system and how it integrates with something like live streaming. So it wasn't really announced or anything like that, but we might have a few viewers from YouTube also listening in. So if you guys are there, very welcome to you as well. So just as a quick test, as always, guys, just let me know if you guys can see the screen and hear my voice. And then we can get cracking with today's session. Great stuff. Thank you, Ashley. Thanks, Mark, Mahesh, Shauna, Sergey, Ravinder, Michelle, Paul, Armand, Sibisisu, Ibrahim, Robert. Very, very, very great to see you guys again today. So let's get cracking with today's session. Today's short-term driver is firstly a risk on turn, overall risk on turn that we're seeing in the markets. If we just quickly take a look at cross asset classes, we can see, starting with equities, equity markets are still very much elevated in today's session and very close to the highs we had from yesterday's session. We will talk about equities in a little bit more detail as we have had a couple of questions coming through in the Q&A with regards to equities as well. Looking at the commodity space, commodities are also looking more risk on the day. We have seen upside in silver, in copper prices, also more supported prices again for WTI as well as Brent crude. Gold moving a little bit more sideways. Also looking to bonds, we have seen upside in bond yields across the board. So in terms of equities, commodities, yields, we are seeing a more positive risk tone. However, if we quickly take a look at the major currency pairs, and if we just quickly pop over to the currency grid, even though we did see a little bit more high beta support at the start of the session, that has moderated somewhat in today's session, nothing major, but we have seen a little bit of downside coming into the high betas like the Aussie, the CAD, and the Kiwi. The biggest surprise mover today so far has been the US dollar. Taking a quick look at the major currency pairs, we have seen a big spike to the upside. Now, this isn't really driven right now by a risk tone. It's not a negative risk tone. We are seeing a positive risk tone. So the only plausible catalyst for that move to the upside is the downside pressure that we saw across the board in the pound as well as the euro. Now, as there's no clear catalyst just apart from weakness in the pound and the euro, it's not really something that we would consider to be tradable. Yes, it is a big move to the upside, but remember the golden rule. We always want to have a fresh and clear catalyst driving the markets. Don't just want to jump into any weird price action moves that we see. It's normally those moves that doesn't have any type of catalyst behind it that sees a very quick reversal. So I'm not calling for a quick reversal in the dollar right now, just saying that without any clear catalyst, it's not really a tradable opportunity that we would look for. So looking at the Aussie versus the US dollar, the Kiwi versus the US dollar, and the USD versus the CAD, we are expecting a low conviction upside bias, or have a low conviction upside bias for the Aussie and the Kiwi, and a low conviction downside bias for the USD CAD based on that more risk on tone that we're seeing in the markets. Keep in mind, it's a low conviction ideas right now because we're not seeing any particular fresh catalyst and driver for the risk tone in today's session either. So we always want to have a clear reason why the market is trading risk on to give us more conviction. Without that clear reason, that clear catalyst, there really isn't any particular catalyst driving it, which is why we do have a lower conviction. We also have a downside bias in the euro versus the Kiwi. Now, the euro is a lot more interesting in today's session. We obviously have seen some additional downside. Now, the euro fell yesterday, of course, after the German Constitutional Court ruling that we had. Now, they basically ruled on the legality of the ECB's PSPP, which is the previous purchasing program that started back in 2015. Now, the German court ruled that some actions taken by the Bundesbank, which is the central bank for Germany, to participate in the asset purchases program were basically unconstitutional according to German law. And they've basically given the ECB as well as the Bundesbank 3 months to respond with a justification to prove that the asset purchase program was indeed in line with the law. And I mean, it's been a massive program. It's accumulated over 2.7 trillion euros of debt already since 2015. So it's quite big. Now, the issue of legality isn't really around direct government monetary financing. That was a real concern back in 2015 when the program was announced. The real issue here is around proportionality. So the court is arguing that the amount of purchases or let's say the size of the asset purchase program isn't really in proportion to the associated economic and fiscal effects and fallouts from that program. So going forward, the ruling obviously creates a little bit of a rift, a further rift between nations like Germany and Italy. You guys will remember we saw downside pressure in the euro on the back of the EU nations failing to agree to any type of relief fund yet. Now that is putting nations like Italy and Spain under a lot of pressure right now. And this ruling from Germany is really, it can cause a further rift. We've already seen some negative comments coming out from Italy this morning. Now, looking at it from a more short to medium point of view, it could hold lots more bigger implications for the euro going forward, especially for the Bundesbank. So if the ECB in 3 months' time and the Bundesbank fails to appease that ruling and basically fails to give any clear reason for it not being against the law, the Bundesbank could be forced to refrain from purchasing any further of the PSPP or participating in the APP program, and they could even be forced to sell some of that purchase debt. Now, the challenge for the ECB with regards to that is that the Bundesbank is the largest central bank in the union, and they hold the lion's share right now of all of that debt. So all in all, this story is far from over right now, and it should mean another downside catalyst for the euro, at least in the short as well as the medium term, which is why we did see that move to the downside and that continuation of that move in today's session as well. Then looking at the big move in the pound, there was a lot of questions coming out, whether that was due to the miss we had in terms of where did we have the construction PMI? So that obviously did come in a lot lower than expected at 8.2, but the move for the pound actually started before the construction PMI came out. So not really attributing that drop to the PMI number itself. And there is obviously other medium and short-term perspectives and factors that is driving the pound lower. In the medium term, of course, we have no progress made so far with regards to the UK and the EU trade negotiation for Brexit, which is obviously a growing and a lingering concern. In the short term, we had some negative data about the virus fatality count that has now basically reached the highest in Europe, which is obviously a big negative, and it is pressuring the pound in today's session. And we also had more negative, like we said, a negative than expected PMIs, but not really attributing that downside to the PMI itself. Now, what can also be driving the pound lower is the expectation for tomorrow's BOE meeting. Now, for those of you that hasn't read our daily risk event outlook report in the terminal, just make sure to go and read up on that. We have some information on what we're expecting from that, but we should have a full preview up and running in the terminal as well, as usual, later today for that meeting tomorrow. Now, the first thing that we need to know from tomorrow's meeting is that it's not going to be the normal time, which is normally between 12 and 1 p.m. GMT. It has been moved a lot earlier to 7 a.m. GMT by the new Governor Bailey. So not really sure why he made that move. Whether there's a specific strategy for him moving it so early. There's also not going to be any type of conference afterwards, but that's probably due to restrictions and not really due to any other particular reason. But they could have had a virtual conference like they had with the ECB. So there are some questions from the market participants right now as to why it's been moved so early and why there's no planned conference afterwards. But anyway, the main focus for tomorrow won't really be on interest rates for the pound. The main focus will be on QE. So the market is currently expecting an increase in the QE program, and it's not really due to the downside expected for the economy, but mainly due to the spending spree and the debt, the UK debt that is currently piling up. So remember, when we have a government that needs money, one of the ways that they basically get money, especially if they need to fund a economic recovery for a pandemic, for example, like we have now, what they do is they normally issue bonds. Now, bonds, UK bonds, are normally called gilts. Now, they issue gilts, which investors will obviously want to buy. So the bond buyer, when he buys that bond or that gilt, he basically lends that money to the government, and the government agrees to pay him back that bond price at the maturity, and in return for that, he enjoys interest on that loan, and the interest is normally the yield at the time of purchase. Now, the problem right now facing the UK is that the gilt issuance has just skyrocketed. So if I just, guys, just give me a second to get this. Well, I actually did load it in the terminal. Let me just quickly open up that chart for you guys. You can see here looking at the amount of gilt issuance that has already taken place just in this first quarter, it's basically almost the exact same amount as the entire year of 2010, with the massive QE program that we saw due to the global financial crisis. So just this first 3.5 months of issuance has already been almost the exact amount of the entire 2010 year. So it's a whole lot of debt issuance right now, which is a little bit of a problem, especially as bond buyers looks at that type of issuance as a possible oversupply. So whenever you have an oversupply of something, normally that pushes the price lower. Now, when the price pushes lower, of course, you need to offer a higher yield or a higher incentive for the bond buyer to buy that bond. Now, a higher yield is a very bad thing for the UK government, because if they have a higher yield when they issue those bonds, they obviously have a lot higher borrowing cost involved with that type of bond issuance. So what the BOE has done is the BOE has basically given a little bit of a backstop where they've stepped in to buy basically all of the extra bonds that the UK government has need to issue. So if you have a look at the most recent QE program that runs until the end of June, I think the total program comes close to 200 billion. Let me just quickly turn this down. So the total program comes close to 200 billion. Let me just quickly, where I can still hear that running in the background. Sorry guys, just give me a second. Yeah. Looks like there's a small technical challenge. There we go. Okay, that's much better. So in terms of the total purchase program, or the Kiwi program that they've already done, that's about 200 billion. That they've issued, and the 200 billion Kiwi is basically almost the exact same amount as that the issuance that we've had in terms of gilt. So the market is very, very sure that the UK government will need to issue even more gilts. They'll need to do even more bond sales in order to get more money to fund the recovery process, and that is why the markets are very sure that the BOE will need to increase that purchase program. So what the markets are waiting for tomorrow is either an announcement that after the June program closes, that they will introduce a new one. The challenge is that for now, the DMO, which is basically the debt officer of the UK, they don't know how much they need to issue. So they haven't really provided any type of guidance, which is why we don't really have any type of idea of the amount of QE that we might get, but the markets are convinced that that is what we might get. So that might be one of the reasons why we're seeing a move to the downside, is that expectation of a further increase in the QE program. But as we said in today's session, we are keeping a little bit more of a sideways bias right now in the run up to that event, rather waiting for that clear catalyst to trade it in today's session as well as tomorrow's session. So guys, that is everything from my side in terms of what we're seeing in the markets and what we're waiting for. Looking at today's upcoming events, nothing much really. We do have the European economic forecast coming out. Now that can have some impact in terms of the overall risk sentiment, which can be tradable, but not expecting a lot of fireworks from it. We also have ADP, national employment. Now, lots of negativity has already been priced in for this data point. Currently, expectations are for 20 mil. With the minimum sitting at negative 25 million and the maximum sitting at almost 9. So a wide range of expectations there. So anything within that range shouldn't cause too much of a move in terms of risk assets. But if we do see a move below the market's minimum expectation, that might see some negative risk flows coming into the market, especially since we don't really have any particular catalyst driving that risk tone positive in today's session. In the same sense as well, if we do get a beat above the market's maximum, that'll feed into that more positive tone that we've had throughout today's session. And that can also create some trading opportunities going forward. So that is everything from my side, what we're looking for in today's session, as well as early tomorrow's session before we have our webinar. So as usual, if there's any questions, please make sure to pop them into the Q&A box as opposed to the chat. It just makes it a lot easier for me to keep track of all those questions. And I'll make sure that we get to all of them. Okay, so let's quickly see. Okay, we have a first one here from Bobby. Not sure if you got this comment a couple of sessions ago, but your patience is awesome and is to be commended. Thanks, Bobby. I really enjoy what I do. So it's always a very big pleasure from my side. Mark has a great question here. Why is the yen so strong today? So that is a little bit of a head scratcher in today's session. Mark, in a normal risk on environment, you would expect your safe havens to be pressured across the board. So we know the Swiss franc is pressured alongside the euro due to the German Constitutional Court ruling yesterday. However, the yen hasn't really given up any of its gains today, especially against the Aussie, the CAD, and the Kiwi. So this is a little bit of a head scratcher. I'm putting this down to the fact that there's no major risk on catalyst right now. If we had a particular catalyst, we might see some further downside. But this is one of the reasons why I am taking a little bit more of a lower conviction in this overall risk on tone, because we're not really seeing the full transmission effect of that risk on tone throughout the currency space in today's session. Bobby has a question. Can you make any or a substantial income only trading risk on risk off in your classic risk on risk off pairs such as the Aussie yen, Kiwi yen, Aussie USD, Kiwi USD, etc.? I mean, the thing is, when risk on and risk off is a very valuable sentiment tool that we can use. And obviously during times like this, it's even more important because you've got volatility that's spiked to the highest in history. You've got the amount of central bank fiscal and monetary policy stimulus that the world has never seen, unlimited QE program from the Fed, etc. So in these times, in this massive, uncertain, recessionary, global panic times, obviously risk sentiment is a little bit more important. But I'd say, when you look at it from a probability point of view, right? You're not always going to have strong risk on risk off opportunities in normal market environments. Normally on a weekly basis, you'll have strong risk on and risk off flows if you don't have obviously a coronavirus in the background that you need to deal with. So normally there are opportunities, but it's not as ample and it's not as big a focus in a normal market environment. So I'd say the highest probability to always work with is just to go with the most dominant sentiment at that particular time. So which is why we went with the euro Kiwi, for example, in today's session, right? So the euro, we're expecting downside for the euro on the back of that ruling from the German court, and the Kiwi dollar, as long as the risk tone remains positive, we're expecting upside for that, which is why we have that downside. So just as today as an example, yes, we have a downside or an upside bias for the Aussie dollar and the Kiwi dollar and downside for the USD CAD. But I've got more conviction in something like the euro Kiwi because I'm expecting a lot more. There's an extra additional, more important sentiment driver for the euro right now compared to just a daily risk on and risk off tone. So I'd say I definitely look to trade the dominant sentiment, whether that is risk on risk off or whether that is something like which is driving the euro or the pound right now. So it's not really. I wouldn't say you can't make a living just focusing on that, but it's not always going to be the main driver in the market. For example, sometimes it might be other drivers. So it's always best to look at it from a macro point of view, looking at it from cross asset classes. Maybe there's a unique opportunity developing in oil markets that you can try to capitalize on. The CAD example, just as an example. So there's many different ways that you can play it. So I'll normally try to just stay on top of the bigger drivers, so to speak. Okay, we have a quick question here from Sukrash saying, can we quickly look at the pound Aussie and the pound Kiwi? Yeah, sure. Let's quickly have a look at those two. Let's pop it up here. So we are heading into a support structure here is the first thing that I'll note. I mean, in terms of the sentiment, we are expecting further upside for the Aussie and the Kiwi. in line with that risk on sentiment. Again, keep in mind, there's no particular short-term strong drivers right now for that risk zone, so it can change very quickly. So just keep that in mind. But as long as that is the case, we are expecting downside in something like the pound Aussie and the pound Kiwi, with that weakness we saw across the board in the pound in the run up to tomorrow's meeting. And then obviously, as long as that risk on tone stays in play. Now, looking at the pair, we do have this support, overall support zone coming in right below that 92, 192.50 area. So I would say this is a good spot if you are short on this already to look for some potential profit taking on this pair, at least reducing your risk, if not taking profit on it. For those that's still looking to want to get short on it, I won't really be interested in selling this right at the session lows, just because we are so close to that 92 psychological level as well as that ADR low. So I'll probably look for a potential pullback, maybe to that overall area. We do have some support and resistance there as well. So maybe a pullback back to that 193 can be something interesting to look at in today's session. Also looking at the pound Kiwi, should be fairly the same. So let's just quickly zoom out a bit. So I'd say this support zone is a very important one that we need to pay attention to. The pair struggled to really break through this a couple of sessions apart from that move we saw lower at the end of April. So what you could do, apart from looking for a pullback, is maybe wait for a break of this level, wait for a pullback back into the zone to then re-engage to the downside. Just keep in mind that there's not a lot of room left to the downside if you consider that 204 level at the ADR low. You might consider something lower, maybe at this most recent fair value area, but there's a little bit of it is a long way to go for the pair, and it is outside the range. I'd say this is a very high probability area to spot for some potential profit taking. But just watch that ADR low. If you do get into that range, make sure that you reduce some risk the closer you get to that ADR level, as well as that 2040 psychological level. In which future conditions or at what level of VIX will the US dollar lose its safe haven demand? So on the VIX, I mean, there's no magical level really. Looking at the VIX, obviously, if we take a look at it from a weekly point of view, the reason why we saw such a lot of inflows into the dollar, apart from just the overall uncertainty that it had in the market, was that massive spike to the upside. So there wasn't really any investable asset classes to hold money for a short period of time, which is why a lot of players started to rotate back into cash, which created a lot of demand for the US dollar. I'd say that the VIX is something that you can consider as a potential, as an additional factor to consider for when the dollar might be changing back to its normal way of running. I'd say the more important factors to consider obviously is the virus itself. So once everything starts to quiet down, once we start to really win the fight in the virus, once we start to see economies opening up, once we start moving more streamlined again, or in some form of normalcy, even though that's not really going to be possible for a long time. I think once the virus is out of the picture, that'll be an important part to watch. Also watching equities, of course. As long as equities is going to remain under pressure, which hasn't really been the case recently, to be fair. But I am expecting this to be more of a short-lived bear market rally. As long as equity starts to tilt, you should see lesser and lesser focus on that demand as the market starts to turn away from that panic. At this stage, however, I'd say the clearest one just to look at is the virus. Once the panic, once the overall the sheer panic in the market has diminished, that should start to see the dollar act more in line with normal monetary policy. Just keep in mind with everything that's going on, especially the monetary and the fiscal policy, it is going to take some time for the markets to rebalance. So we've seen so much synthetic propping up of asset prices right now in terms of the unlimited Kiwi program from the Fed. Looking at the euro bond buying, looking at the BOJ bond buying. So there's a lot of synthetic propping up going on right now. So the market hasn't really had a lot of time to rebalance, so to speak. I think once that rebalance is starting to take hold, we should start to see the dollar trade more in line as being the dollar and not a safe haven. But also keep in mind there's other things like not only the Fed's QE program, but also financial repression around the world. So you've got central banks around the world that's currently trying to devalue their currencies as much as possible with QE. And for that reason, the dollar might stay in demand for a little bit longer than some analysts are currently expecting. Whether that is going to be due to simply pure safe haven flows or whether it's just going to be due to the dollar being the most attractive major out of all of them, that's obviously left to something we can argue about. But I'd say until everything calms down, that safe haven appeal should still stay there. We have a question from Samuel. Is there any high conviction trades for today? Samuel, not anything that I can see from my side, to be honest. I mean, we have the Euro Kiwi, which is our dominant currency sentiment theme for today. But this, I won't call this a high conviction opportunity. I'll say this is more of a medium-term conviction, again, because even though we're expecting a downside based on the risk on tone doesn't really have any key drivers right now. So there's no catalyst that really that's giving me a lot of conviction for sustainability to the downside for the pair or for the upside in the Kiwi, for example. So until we have a clear catalyst and a reason for the market to trade risk on, I'd say the base that we're getting in today's session is a medium conviction for something like the Euro Kiwi, and then a more lower conviction for the dollar crosses. Let's quickly see. We also have a question here from Anderson wanting us to quickly look at the US dollar Swiss franc. Okay, so let's quickly open up the US dollar Swiss franc. So if you missed our video on for this one today, just make sure to go to the video commentary section and just scroll to the USD Swiss franc. It should be somewhere in the feed until, just make sure if you can see that one. Looking at it from a purely risk center view, I mean, we had lots of downside in the Swiss franc yesterday, as well as today's session on the back of the German Constitutional Court ruling. So that saw lots of downside, not only in the euro, but also in the Swiss franc. So the Swiss franc is being driven lower right now on the back of that ruling. The US dollar, obviously, as we said, no clear catalyst right now, apart from the moves we're seeing to the downside in the euro as well as the pound. If it's just based on the risk on tone, we're actually expecting more weakness for the dollar. So the dollar hasn't really moved the way that we would have expected to in this more risk on environment. So for today's session, like the USD yen, we also have more of a sideways bias on the US dollar versus the Swiss franc. Remember, when it comes to trading, we always want to have a high probability opportunity for something. And obviously, the higher conviction we can get is obviously going to be great. Sometimes you might not get a high conviction, but you still have a high probability. So looking at it from a probability point of view, yes, we've seen downside in the Swiss franc, which has propped up the USD versus the Swiss franc. But because both of them are trading like safe havens, not so much today, but obviously in the more general sense right now, there's no clear tradable opportunity on the US dollar versus the Swiss franc in today's session. If we do see a major risk off move, for example, we would expect that to have more, be more supportive for both currencies. Strong risk on should be more, add more pressure on the currency. So not really seeing any major clear trading opportunities for that in today's session. I would stick to something with the, something like the Euro Kiwi downside, or stick to something like the Aussie Kiwi upside. And then of course, USD CAD downside as well. Quick question from Kyle. Is the VIX a good reference for risk on risk of sentiment? Definitely, definitely. It's a great way. I mean, there's a reason why we look at it from a cross volatility or cross asset volatility basis. So this screen basically shows you the entire volatility, let's call it complex. So you have anything there from the VIX, which basically tracks the S&P. You have the OVX, which tracks oil price volatility. You have GVX, which tracks gold volatility. Then you've got currency volatility as well. The TYVIX, which tracks bond volatility. And then you also have high yield, and then the EM. So the VIX, as a general sense, is a good reference point for overall risk sentiment. Whenever you see the VIX spiking up, that is normally a sign of risk off flows. And whenever you see the VIX coming down, that is normally a good sign of risk on flows. Now, obviously, that it's a little bit different in an environment like we are trading in right now, with VIX, trading at historically sky high levels, with most of the other volatility indexes. It is a little bit skewed right now because you're coming from a very high point, and that move to the downside is one of the mathematical reasons why we're seeing more upside in terms of equities across the board. But just from a general trading point of view, we do always look at the volatility index. You'll see that's right. On the right-hand side of the bottom chart, that's always something we have up to see that if moves we see in the equity space to the up and to the downside, whether that is actually followed up with the inverse moves in the volatility index. So it's definitely a great tool to use in terms of overall an overall gauge of risk sentiment. We have a quick question from Bobby. You noticed that on the investing.com profile, commodities less platinum is missing. I just wanted to know, is there a reason for that? And if we should add it to the list, what is the symbol for platinum so I can add it to my commodity list? I'm not sure what it is on investing.com. Let's quickly open that up. The only reason why I really didn't add it to the portfolio in investing.com is because I actually built out a similar one in Zenith. So everything that I looked at on the various screens on the investing.com platform, so whether it's equities or commodities or yields, etc., I've basically built the exact same thing on Zenith. So I basically just look at this. So from the top here, we have North American equities. Now this is the futures pricing, equity futures. So we have equity futures for the American session, for Europe as well as Asia. Below that, we have the commodity list, and then below that, we have bond prices. Now, looking at the platinum itself, you guys will remember from our charts, we normally had silver, we had copper, and then instead of platinum, I used to have the CRB index from Reuters. Now, the only reason why I swapped that out for something like platinum is, firstly, I wanted something that trades throughout the session, so not only trades during the New York trading session like the CRB index. If you guys know of any futures index that tracks commodities, I will more than be, I would like to have that up more than platinum. So I've basically just swapped that out with platinum for now to be able to have a broader view of the metal complex overall. But the main reason is because there's really no other commodity futures index that I can see that we can have up on the screen. If we get something like that, it'll be a much more valuable metric to use compared to something like platinum. So no secret sauce with this one added in the mix there, Bobby. We have a quick question here from Armand. What does it mean to fade a move? So let's quickly see if we can find an example. Let's use tomorrow's yesterday's move in the euro versus the dollar. So we had that announcement coming out yesterday on the German court ruling. So we saw lots of downside in the euro across the board. We reached that overall support structure, and then suddenly we saw price move around, and it suddenly started to move back up quite strongly in yesterday's session. Now, a fade of a move would be when you basically fade this this reversal to the upside and basically trade it to the downside. So you fade the pullback and you basically trade it in line with the overall trend. So whenever you see a spike, a massive spike to the upside, so let's take this one that we had based on the month-end rebalancing. Whenever you see a spike like that, when traders say that they are fading the move, means that they are using that move to the upside to just basically sell that at a better price. If it's another type of trade for a buy, they'll basically fade a move to the downside as an opportunity to basically just buy at a better level. So it just means that you're ignoring the short-term spike and you're basically trading against it. We have a question from Abu. Abu, I'm not actually sure what that is, to be honest. Can you give me a little bit more info on that criterion? I'm actually not sure what that is. Okay, we have a quick question from Mark. How's it, Mark? How can we discern when stop hunting is happening? Weird price action on a short Wall Street trade around 2 a.m. in 23.93, closed at a 23.76. Stop was beyond previous fractal. Also suffered double spike in euro US dollar yesterday before the price returned back to the support level. So it's this one here, I'm presuming. Sorry for the long question, just trying to understand what's happening. Okay, cool. So, I mean, the one thing to remember about stop hunting is it is a real thing, but it's normally not something that's done by a broker, as many people think. It's normally done by the big players in the market. So for most brokers make money from spreads and commissions. So there's really no incentive for them to do stop hunting, because it doesn't make a lot of sense from a volume business point of view. So the business models they use are basically hoping for people to stick around as long as possible. So the real reason why we see stop hunting happening is from big players in the market. So let's take the euro versus the US dollar as an example yesterday, right? So let's say the move happened and you are somebody that wants to put in a trade of let's say 200 million on the euro dollar. So it's going to be very difficult for you to basically fill that order, to basically to be able to execute that order if everybody in the market is selling to the downside. So what these guys can do, they have enough capital at their exposure to basically move price in the opposite direction for a short period of time. So what you normally see happen is you normally see the market move against a particular spike to the upside in the short term, just to eventually reverse all the way back down, like you're saying, back to the support zone. So this might have been something like a stop hunt. I don't think this was, because if it was a classic stop hunt, it probably would have spiked back to above this level. Because if you traded this to the downside, that's probably where you would have had your stop, or maybe above that level. So when you have a move like this and you see a spike for no reason, there's no catalyst, the thing spikes up to, let's say, just above that level, and then it just reverses and resumes course. That's normally your stop hunting taking place, and that's basically big players in the markets pushing the price up against the actual move to the downside, and they know that there's going to be a pocket of orders sitting at that level. And if they see that order pocket sitting there, they know there's not enough liquidity for them to actually execute their order. So they'll push it up to that level, find enough liquidity, execute their big trade, and then suddenly you see the market move down. So that's one of the reasons why we prefer not to normally, in a normal environment, not to use the very first swing point, or we normally stick to the second one, or the second fractal. Now, there's no way of knowing exactly when it is stop hunting. That type of environment is normally attributed to something like stop hunting, but there's no list or grid we can use to say, oh, okay, yes, that was a stop hunting move. So it is very, very speculative of when it is happening, but that is normally the telltale sign. So looking at something like the euro, I don't think that was really a stop hunt, because that wouldn't really be an area where a lot of people had their stops. It would have been somewhere in this zone. this can be an example as well. So let's say somebody wanted to trade this long, that spike to the downside would have taken out quite a lot of players before the move edged back up. So that might have been one. I'm not saying that is, it might have been just a normal catalyst driving it up. But that's just an example. So I don't think the euro was really that type of reason for why we saw that spike to the upside. It might have been some liquidity hunting, but I don't really think that was the case. How you can basically just try and get around something like the possibility of a stop hunt is just to make sure that you always give your trade enough room to breathe. Sometimes the other thing that might happen is just your something that your broker can do is increase your spreads, right? So if I have any trades running during the Asia Pac session, which is it's very rare that I do, but if I do, I'll normally like to move my stop a little bit further out because I know that the brokers will, due to that thinner liquidity environment, like to spike the spreads. So I always try and move it out a little bit because you might get taken out of a trade for no other reason just than your spread being spiked. Now, if that happens quite a lot, then that might be a good sign for you to look for another broker, because maybe the broker is using that as a way to obviously make more money, which is not really a broker you want to be trading with. But those type of things are very speculative. It's not something that you can know for certain. Okay, that is what happened. So if it was a spike, it might have been spread. If you did use the second swing and the second fractal, it might have been just a spread taking you out of those trades, or maybe just a short-term catalyst that moved against you, that spiked you out. Okay, awesome there, Mark. Okay, we have a quick question from Joseph. In the analysis of the market overnight, something was mentioned regarding the EPS US dollar value of 170. It was regarding the 280.90 region of the SPX. Could you explain what was written? Joseph, I'm not exactly sure what report it was. I'm actually not sure what that was, mate. But what I'll do is I'll make a note of that, and I'll just ask Giles tomorrow to quickly take that up with you guys. By the looks of it, just quickly looking at the question, I think it might be something. If it's with the SPX, it's probably due to just a valuation. So it might be something referring to possible valuation on the pair. But I'm not sure exactly what that one is right now, mate. Sorry. Okay, awesome, mate. No worries. Okay, so Abu is saying that with the question you meant, how can we track our trading, whether we're doing good or whether we're doing bad? For example, on your side, you've been trading live markets from the last 7 weeks, and you've made 9% of your total account. So that is a good one. That's a great return, mate. Well done. That's awesome, awesome achievement. I hope that you're keeping your risk low as well, and that you're not over leveraging. If you kept your risk parameters in line, that is a great result. So congratulations on that. I mean, there's a couple of ways you can keep track of it. I think the easiest one that I used to use was my FX book, because I could have linked that up with my MT4 platform, which is great. Obviously, they don't have access to. There's some brokers it doesn't work with. I'm not sure why, but my FX book was always a great one I used to use to keep track of it, because you don't need to manually record anything. Everything is basically tracked for you automatically. But there's actually quite a few journaling software available out there for traders. There was one I used to use. I can't remember the name. They had a subscription fee. It wasn't much. I think it was like $29 or something, which worked okay. But I mean, it's something that I I stopped doing quite early on, for no apparent reason. I think I just got lazy, to be honest with it, which is why I went over to just something like my FX book. But I mean, there's lots of different journaling software out there that's very valuable, that you guys can look into. Okay, cool. So Mark, you're saying that it was 2 trades. The stops were at 10,860. Let's quickly check. Let's pop that in. 860. It's that one. Okay. And the other one was at 863. Okay. So when you were trading these ones, did you trade this to the downside, and that's where you had, was it this spike that took you out, Mark, or was it just was it another move? Was it that spike? Okay, cool. So I mean, I wasn't really in the session yesterday. You guys would have seen that Giles did the video commentary. But what I saw from the price movements, there wasn't really any major reasons or catalysts for that move to the upside, for that move. Trading something like this, once we've moved down lower, that's probably one of the times when I'll start to move my stop down a little bit. If it's this type of short move, I probably would have kept my stops elevated a little bit, just in case we did get a little bit of volatility. But obviously, that is in hindsight. I might have moved it down as we moved lower, and I might have been taken out of that trade as well. So just looking at it from a process point of view, I'm not sure exactly what area we looked at from a possible support zone. Whether it was this area, it might have been that area. I'm not sure which one the guys had loaded up on the chart. But if it was there, I probably would have, if I entered this somewhere up here, I would have taken profit here already. And then if the market moved back up, I probably would have taken a second entry. But in terms of moving the stop lower, if it's that close to the level, I'll probably just close it out, then have the stop close to the support zone, if that makes sense. But in terms of the reason for that spike, I don't really think it was stop hunting. I think that was just maybe just a pullback, just a price action pullback, really. But as I said, I wasn't in the session yesterday. But from the analysis markups that I had, I didn't really see any particular reason for that spike. Okay, awesome. Yeah, I mean, you know what? Maybe under another environment, it would have held nicely. Like I said, in hindsight, hindsight is always going to be that exact science, So me looking at it now is like, okay, I probably would have kept my stop there, knowing that it spiked up. So I might have moved it down as well as we moved closer to that level. What I normally try to do from a process point of view is if I do have that support zone. So let's go to one of the examples today. So let's say we have this overall resistance zone that we're looking for a potential target area. If I see price move close to that zone, I'll probably just take profit there, instead of, let's say I had my stop somewhere over here. The moment I'm moving very close to my target area, I'll start to move that stop up. So have more of a dynamic stop as it moves. And if we reach close to that level, apart from having it somewhere like over there, maybe, I'll just take full profit there, unless I'm expecting a move to the downside, or a further move to the upside. Then of course, moving it up and seeing if you can get something more out of the trade is obviously something that you can do. And personally, for me, if I've reached my daily target, so to speak, for that particular pair, I'm happy just to take it off there. Because I've had so many trades where you enter, you're right with the sentiment, you ride it up, or in the euros case, you ride it down, just to have the market pull back for no apparent reason, take you out and then continue lower. So that's why for me, if you entered somewhere down here, it's another story. Then you probably would have wanted to mitigate your risk a little bit. But yeah, I don't think there was any wrongdoing, so to speak, from some participants with regards to that spike. I think it was mainly just a pullback on that one. Quick question from Richard. Is the crude oil inventories data released today a tier 1 data point to confirm the reduced production output is helping? I'd say it's you could classify it as a tier 1, especially in today's session with everything going on with crude. So we know in the crude prices we had that upside in the last 2 sessions. Basically from not only the OPEC deal that started, that was fully priced in already, but as more and more rigs start to close down in the US and some of that production gets cut, that is basically coinciding with that. So I'd say it is a very, very important point to note for the oil, for CAD as well. Whether it's, tier 1, if we see a big enough deviation, I think you can classify it as a tier 1. If not, then it might not really have too much of an impact. But if we see a continuation of that draw building in the Cushing stock, that can really see some additional upside. So it is definitely a risk factor that we need to pay attention to for today, especially for the CAD. Okay, we have a question here from Armand. What's the range of the number of pips that you'd be looking for on an intraday basis or for an intraday trade? Is something around 50 pips a realistic intraday target in general? So I'd say the one thing that I'll say on generalized targets is that you need to be very, very careful with looking at the targets that way. The only reason for that is that it's always going to depend on a couple of factors, right? So the first one, just from a mathematical point of view, is obviously the expected volatility for the pair. So looking at something, let's take the Aussie versus the US dollar. So based on the last 10 days worth of price action, we can expect anything from 60 pips to the up or 60 pips to the downside. So a much bigger range that we normally have on something like the Aussie versus the US dollar. So in a environment like this, you're always going to have your targets are always going to be slightly bigger compared to just a normal, slower moving environment when we don't have coronavirus and everything else going on in the background. So it really does depend on the volatility for the pair itself. So what has it been doing over the last 2 weeks? Is it a reasonable target to have? So always look at your ADR high and your ADR low, and then also just use your most recent technical areas for that. So if we have a look at this particular chart, or let's take something completely different. Let's take the USD CAD. Okay, so looking at the USD CAD, we're looking for a possible re-entry area from this zone. Now, looking at the chart from a target point of view, there's a couple of things we can consider. We can obviously consider the ADR low. If we just consider the ADR low itself, that can be a potential target of 120 pips, which is crazy high for the pair, but it's in line with that volatility gauge for the session, right? So looking at the other factors we can look at, obviously support and resistance, fair value areas, etc. If we take a look at this pair, we've got a couple of confluence factors here. We've got the 140 psychological level, well within that ADR range. We also have this overall support and resistance structure going back to that swing from the 23rd of April. We also have this from the 28th. And then, of course, these two most recent support touches as well. So you're always going to look for the highest probability zone based on the volatility and based on your technical analysis. So whether that gives you a range of 20 or 50 or 100 or 150, it's obviously going to be different from pair to pair. So a pair like the Euro Kiwi, for example, that should be much bigger. That range, even though it doesn't look that much bigger, it should be a lot more pips. So you can see that's almost 100 just down to the ADR itself. And if you compare that same type of visual move, it might just be like 30 or 40 pips on something like the Aussie versus the US dollar. Just a rough example. So I would encourage you not to really think of it as a set, like a hard rule, like between 30 and 50 pips. I'd be happy with anything like 30 or 50 pips on a day trade. But in times like this, it might be a lot more right now, just given the amount of volatility we see. So anything I'd say between 30 and 50 is fine. But as I said, you might be trading the pound Aussie, where it might be 100 pips, just based on the volatility, based on your technical analysis. So it is really pair specific itself, based on the volatility range and your technicals, and then of course the sentiment that you're trading. So if it's just a normal sentiment based trade like this one, you're always going to look for your closest confluence areas in terms of support and resistance to look for that targets. If it's something that is unexpected, a massive shift. So imagine you're sitting looking at the USD CAD, and suddenly you have an announcement coming out over the squawk, and it says that Saudi and Russia has been talking, and they have decided that between them, or OPEC Plus has had a secret meeting, and they've decided to cut an additional 10 million barrels per day. That is something that, apart from obviously trading oil itself, that is something that you can jump into USD CAD, you can sell it, and I'm not only going to look for this type of target, right? So if it's that type of shift, you're probably going to see a massive spike already. So with that type of sentiment shift, I'll still look for levels, but then I'll be a lot more ambitious with my target. So if it's something like that, I'll probably let it ride down for a second or a third support area or resistance area to the upside, and then take profit. So it is based on the pairs volatility itself, and then based on the actual sentiment that you're trading as well. For just a normal day trade, it's normally going to be a closer target than just having it run, but it is normally going to be based on the actual volatility of the pair, which is why it's also a good idea to look to beta adjust some of your risk on a trade. So let's take the euro dollar, for example, right? So let's say yesterday you jumped in at the news of the German Constitutional Court. So let's say you got a bad fill and you entered somewhere over there. The safest place for you to have a stop is probably going to be either above that level or above there. You would have been well within ADR. If it was at the same place, it might have been higher yesterday. So let's say you place your stop over there, just hypothetically speaking. So your risk on that would have been 74, 75. So if you're trading 1-to-1, that's a very manageable risk to have. So that if you're trading 1-to-1, in terms of leverage, that's going to be roughly 0.75 or 0.77% risk. So less than 1% risk on a day trade, which is fine. If you're trading something like the Euro Kiwi, for example, so let's say we use this most recent swing. It's probably not going to be that much, but let's say it's about 100 and let's say we use the second swing over there, or just below the ADR high. That's 167. So if you take that at a 1-to-1, that means that you're almost going to risk 2% on this trade at a 1-to-1 leverage, which for me is too much personally with my risk appetite for a day trade. So if it's a big volatility range pair like this, I'll probably beta adjust the position to say that, okay, this is the spot where I want to have my stop. But I'm not gonna risk 1-to-1. I might risk less than 1-to-1 because I want to reduce my risk on that potential trade. So it's always good to look at it from a volatility point of view, as opposed to a hard rule in terms of the amount of pips. Carl is saying that TradingView has platinum futures symbol as PL1. Let me just see which one I have here. I'm actually trading Oanda's one, which is just XPT USD. But the futures one is, you can use the futures one. It should be the June contract. Normally you'll see the contract start to move over within that month at the month end. But it might be, yeah. So I'm not sure exactly what contract it is, but I just use the Oanda one because it normally runs throughout the session as well. Yeah, Oanda's one. I mean, I did try to use the futures one, but I see their feed is very constant, and I mean most of it is going to trade on a CFD basis. It's gonna be a futures contract anyway, some derivative of it. So I prefer to use them for all of it because it's nice clean charts. They're updated regularly. I haven't really seen much deviation from some of the other brokers. So I prefer to have everything with that broker. Then at least you have a more stable feed running across the board. But it's not like I'm not recommending them as a broker, so to speak. It's just nice to have everything on from the same provider. We just have a question from Kerrick. Kerrick is saying, how's the team? You've had some very good success for 2020. Your trading skill level has grown, obviously, since joining. What fund of programs in regards to prop firms do you recommend to get started with? I mean, there's actually a couple. There's a couple of programs out there. I know that one of our subscribers, I'm not sure, Tudor, if you're in the room, Tudor did the one through FTMO. I think he did the FTMO one. We have a challenge where you can go through, and then obviously if you get through the challenge, they fund you, and you obviously share the profits. And I think they have a quite a interesting profit share. The best thing to do, really, there's no like perfect one out there. I think there's about 3 or 4 big players that offers the funded programs. The best thing that you can do is just make sure that you do a very good due diligence of all of them. Make sure that you understand the rules associated. So some of them might have some sticking points with regards to the rules. So you can only risk this much, or you can only have so many open trades running, and I can understand why a lot of them would have restrictions in, because obviously they want to make sure that you can adhere to rules if you're trading their capital. But obviously some people trade differently, right? So you might have 2 or 3 cyclical trades running that might be running for the next 3 to 6 months in the background. So maybe trading bonds or gold or something like that, which can eat up a lot of that margin. And if they have rules where you need to close a position, you can't have, sorry guys, you can't hold it overnight. That obviously you can't really trade that way. So make sure that you understand all of the rules, and that it fits in with your particular trading style. But there's really there's no like perfect one out there. It's really going to be down to just doing some due diligence, and making sure that you're comfortable with the particular rules that they give you. Okay, we have a quick question from Armand. Can you share the settings that you use for the ADR? Yeah, sure. So we just use the input, the look back, or the back period. This one is 1. So this setting on TradingView specifically just means that I don't want to see more than 1 day's ADR, just 2 days. And the ADR length perimeter itself is 10 days. So basically two trading weeks worth of volatility. Okay, sorry guys, I'm just quickly going through. For some reason, I'm not seeing the cues. Okay, cool. There we are. We have a question from Andrea. Could you please comment on the US dollar lira? It's going up and up. What's happening? What causes are behind such a big move and that trend? Okay, so I mean, let's quickly have a look at that one, just to make sure that I mean, we obviously don't trade, or our analysis doesn't really involve a lot of the EM currencies. Our specialization is in the major ones, but I mean, we do trade multiple asset classes and multiple currencies as well. So I do keep an eye on the emerging market, but it's not something that you'll necessarily find as part of the daily commentary, etc. So what's basically going on with the lira, and it's not only the lira itself. It has been hit hard for the lira, but it's basically the think of it as incentive for investors to invest, right? So when you have something that always goes for your emerging market currencies is having higher yields and higher interest rates. So the only way that you can incentivize an investor to invest in your emerging market country is if you offer a high yield on your bonds, or you offer them a higher interest rate, so a positive real interest rate. Now, the big problem for the lira, specifically for Turkey, is they've been on a cutting spree in terms of policy. So they have aggressively cut the policy rates. And the problem for Turkey is that their inflation, their real interest rate has now gone negative. So there's really no incentive from a emerging market point of view why investors would want to hold investments in Turkey, because they're not getting any yield from that. So they might as well invest that money in the US, where they will get a similar type of return. So real rates have gone negative, which is a very big one, which is why we've seen the lira basically just tank across the board, especially versus something like the dollar. And the other problem that's also weakening it is the expectations of inflation. So with all that depreciation of the currency, there's always that fallback or that pushback in terms of inflationary pressures. So that is basically, the markets are looking forward to that, saying that, okay, you've cut interest rates, you're now looking at negative real rates, or you are at negative real rates right now. And apart from that, we have expectations for inflationary pressures to come in, which means that it'll push you into even more negative real yields or real rates. So from a short-term point of view and a more medium-term point of view, there's really no incentive right now for anybody to invest. And that is why you've seen such a massive move to the downside in the lira, especially versus something like the US dollar. So it has to do with rates. It's the same type of challenge for a country like South Africa, for example. You haven't seen the same type of moves, but this upside, this most recent upside that we've seen, has basically been exacerbated by the SARB, the South African Reserve Bank, that also had to cut interest rates. So they cut interest rates by 200 basis points already from the start of the year. So all of that yield differential, that thing that causes investors to want to invest there, all of that that is starting to slowly erode away, and that is according to seeing lots and lots more downside for your emerging market currencies that usually had very high interest rates. They're now also cutting interest rates quite aggressively. So that's a very big negative point for any emerging market currencies right now. But the lira, obviously, much more so compared to something like the ZAR or the Mexican peso or the ruble, etc. Okay, great stuff. Turner said that they just joined the FTMO challenge today. So good luck with that, mate. I really hope you do great. I really hope you have awesome success with that one. Let me just quickly see. I don't see any more questions in the Q&A. I'm not sure if the live stream is still running for YouTube, if there's anybody still there, but if there's anybody there and you guys have questions, you can pop them into the queue as well. We'll take a couple of minutes to see if there's questions from you guys. Let me see if there's any questions in the chat. I think we've touched on most of them. Always a pleasure there, Armand. Always a pleasure, mate. James, okay, awesome, mate. Glad you enjoyed it. The name of I think they just call it the FTMO challenge. I think it's just called the FTMO challenge. If you go to their website, I think they have 3 different phases where you can try out. So it's obviously going to be ranked in the amount of money that you can manage. So I'm not sure what the pricing is, but every level has a specific price, depending on what type of amount you want to try and manage, and then you need to do the challenge according to that level. But yeah, I think the website will give you more info on that. There, James. Not too sure exactly what they offer. Okay, awesome. No problem, mate. No problem. Okay, it looks like we've gone through our Q&A. We've gone through the chat as well. If there's any other sub questions, please let me know, and we'll quickly go through them. Otherwise, I'll quickly have a look at the live feed and see if there's any questions from the YouTube guys. Let me quickly have a look. Okay, great. There's a few guys in the room. Welcome, guys. For those of you that missed it, we're obviously just doing a little bit of a test to see how our live streaming is working with the terminal. So it's looking like it's working quite well. Let's see if there's any questions. For the Aussie US dollar trigger a sell-off. Robin, can you give me a little bit more than that, just to make sure exactly what you're asking there? Okay, we have a question from Godspeed. Okay, you got here late. Where can you go to learn about sentiment from the beginning? Do you mean for today's sentiment, or just sentiment in general? Dion has a question. Before the announcement by the German lawmakers, the euro was weak. What do you attribute to that? So in yesterday's session, the thing to remember about the euro is that the bias is still to the downside, both in the short as well as the medium term. So we had that big spike last week, Thursday, just before the European and Asian markets closed on Friday. So there was thinner liquidity on Friday, which exacerbated that move. But the main reason, the main catalyst for that spike to the upside was month-end rebalancing, not only dollar selling, but also euro buying. Lots and lots of buying pressure coming in with a record move in terms of rebalancing for portfolios for the euro. Now, that obviously saw a massive spike to the upside, and that continued onwards in Friday's session. But looking at it from a fundamental point of view, there was absolutely no reason for the euro to gain that much ground against the dollar. So the expectation was for further weakness in the euro versus the US dollar, especially in the softer risk tone we had from the start of the week, with the negative comments coming out from President Trump as well as Mike Pompeo over the weekend with regards to the US-China trade tensions. So that saw some support for the dollar across the board, which is probably why we saw some downside. But I mean, to be completely honest, the amount of downside before the announcement was it wasn't really moving or going anywhere. These type of movements are it's basically just the ebbs and flow of the market. So there wasn't really any driver. The market was waiting for that particular catalyst to happen. So if you're talking about the move that happened on Monday, of course, that was due to the risk off tone. If you're talking about yesterday's move before the event, there wasn't really any particular catalyst. Just the market moving a little bit more sideways until the event actually occurred. Okay, so you're trying to Godspeed. You're trying to figure out how to use bond yields in your trading. Okay, so there's basically 2 quick ways that you can use it for. In the short term, you can use it as an additional gauge for risk sentiment. So obviously we look at cross asset classes. So we look at equities, we look at commodities. You can look at bond yields as well. Normally when you see bond yields coming down, that's normally a sign of risk off. When you see an increase or rise in bond yields, that's normally a sign of risk on. Now, keep in mind, there's other factors, multiple factors that can be affecting the yield, such as interest rate expectations, interest rate changes itself. Obviously, if the Fed is involved in bond buying, which it is, that can also affect the flows. So keep that in mind. But from a short-term perspective, that's normally an additional gauge you can use. From a more longer-term perspective, obviously, there's a couple of things you can use it for. Interest rate expectations is one of them. Looking at the US, for example, if we go to the daily time frame, normally your bond yields will fall whenever you have interest rate expectations going down, and you'll have your bond yields rising up when you have interest rate expectations going up. So with the economy, the US economy basically starting to slow down from the end of 2018, that is why we saw the bond market starting to price in lower interest rates with bond yields coming down even before the Fed actually signaled its very first interest rate cuts, which only happened later in 2019. So whenever you see bond yields coming down, that's normally an expectation or a sign of an expectation for lower rates. And the inverse, obviously, when it goes up, that's expectations for higher rates. Now, it shouldn't be confused with the type of environment that we're trading in now. Obviously, that massive drop to the downside wasn't just expectations of lower rates, but it was the actual Fed cutting interest rates by, what was it, 175 basis points in 2 weeks. So that's obvious. You need to take it in context with the actual environment that you're trading in. But generally, you can use it as a gauge of interest rate expectations. And then you can also use the spread differential between different currencies as a potential way to gauge divergences in the market. So if we stick to the US 10-year, let's go to the euro. This is actually something that we touched on yesterday, just quickly. So looking at this from a daily point of view, we obviously had the downtrend start in the euro US dollar, going back all the way to the start of 2018. Now, if we quickly just compare the Bund and US 10-year spread to each other, you'll see what I mean. There we go. So here you can see in terms of the spread, the bond spread between the US and the German 10-year, you can see that the bond markets was pricing in a lower euro US dollar going back all the way to the end of 2017. But you can see at the same time, the currency markets was actually pricing in the possibility of higher interest rates, and that saw lots of increase in the euro versus the US dollar. So the bond market actually, they had the move right, basically expecting lower rates for the euro and expecting higher rates for the US, which is why you saw that yield differential move down. And then eventually you can see after a while, the currency pair started to move down in line with that move to the downside. So there's a couple of ways you can use it. Short term, as we said, more as a gauge of risk tones. In the longer term, as a guide for interest rate expectations. And you can also use it as a possible yield differential checker to make sure that there isn't any huge dislocations between how a currency pair is trading and how the market is currently pricing in the spread or the interest rate expectations versus those two central banks. Okay, we just have a quick question from Angel. Please elaborate on how to take trades on a larger time frame like the daily or the weekly. What do we trade, sentiment and SR levels or fundamental outlook? I find more important the sentiment plus the technical analysis on the intraday. What algorithm to use on the daily plus the weekly? Okay, so looking at it from a longer term perspective, you're always going to start with your macro fundamental outlook, right? So in the terminal, in the currency research section, you'll normally see we have the weekly updated fundamental drivers report. So that'll give you the current let's call it a 3-month outlook or quarterly outlook for all the major currencies. So whether we have a bearish bias or a bullish bias or a neutral bias, etc., based on the macro fundamental outlook. So normally when you're going to trade something like the daily time frame or the higher time frame, you're not going to be too concerned about the short-term sentiment, because it's going to be more based on the macro fundamentals between those two economies. So that'll normally be the best trades that you can take from a daily point of view, daily time from a longer time frame, will be your central bank policy divergences. So when one central bank is planning to cut rates and another one is planning to hike rates, that's normally a great opportunity for you to expect some big moves, especially on the longer time frame for that particular currency, or currency pair rather. So you can look at policy divergences. The best way for me to trade from the daily time frame or a longer time frame is basically to include both the macro fundamental outlook as well as the sentiment. So normally if you have a downtrend, so let's take something like the euro versus the US dollar, right? We have a downside bias on the pair. Obviously, the most recent action has been very choppy based on the everything that we've seen happening in the markets. But let's say it's just a normal running of the mill. We don't have all the extra additional stuff running in the background. How do you take a daily trade, or let's say a swing trade, or a longer time frame trade? So you're always going to look for bargains, right? So when you have a downtrend in something, let's say like the euro US dollar, I'm not going to be interested in selling this right at the lows on the daily time frame. I'm going to look for a bargain, or I look for a pullback to be able to trade that from. So whether you use that as a Fibonacci retracement, whether you use it as psychological price levels or support and resistance areas, I mean, the technical reasons that you use can be one of 1,000 things, right? The most important thing is that you have your direction right in terms of the macro fundamental outlook, and that nothing has changed for that particular pair. Then what I like to do personally is I like to wait for the market to trade against that underlying macro fundamental picture. So that'll mean an upside move in terms of the euro versus the US dollar, with no particular longer term consequences. I'll wait for a short term catalyst to move it against that trend. And the moment when you get a catalyst that then reaffirms or basically moves in line with your fundamental or your macro fundamental bias, that is going to be a great opportunity for you to take a short or a buy on that particular currency pair. So a great example of this was actually last week when we had the euro versus the US dollar shoot up to that 110. 110 was just a great level to short from, both from a technical point of view, because we had that same level. We basically tested the same level we traded at earlier. Come on, what's wrong with this thing? Let's just try a high time frame and see if that works. Come on. Sorry guys, I'm not sure why this thing is taking its time. Okay, so anyway, if this thing decides to load eventually, you'll see that there was a resistance at that same 110 level. There we go. Okay, so on the middle of April, basically, we had a test of that same level going back. Now we highlighted that as an opportunity from a more medium-term point of view in Friday's session, that this is a good spot where some medium traders will look to re-engage the pair to get some value out of the trade. So basically selling at a bargain level. So trading to the downside was in line with both the macro fundamental point of view. However, the short term, we had a catalyst that basically pushed it against the price, but it wasn't a month-end rebalancing. The reason for that move to the upside wasn't really anything that we would have expected to last much longer than Thursday's session. But obviously due to thinner liquidity, it moved, it continued to move higher in Friday's session as well. So that was a great opportunity to basically short from a technical level in line with the macro fundamental bias, but we didn't really necessarily have the short term in line because there wasn't a specific catalyst driving it. Then, of course, at the open of Monday, we had that negative risk tone, and in line with that negative risk tone, so let's say you missed that 110 entry on Friday, and you didn't take it as a longer term trade or a swing trade, you could have waited on Monday. So Monday we had the negative risk tone in the market that had expectations for upside in the dollar. So even if at the market open or during the day you took a short, you were still very close to that 110. You could have basically just basically took that trade to the downside to this most recent fair value low, which is one of the trades that I had running in the background. So there's a lot of ways that you can use it. For me, I like to trade in line with that fundamental bias, but look for bargains basically with the short-term sentiment that gives you a great bargain to sell from. But obviously, I jumped the gun on this one. I basically went against my own process. Normally, I don't jump in against a catalyst that's driving it up. But month-end flows wasn't really a particular catalyst that I expected to have consequences into Monday session as well. I expected that to basically fade out, which gave me an opportunity to sell at a great price. But if it's a specific catalyst driving it up, apart from month-end flows, obviously rather have the patience to wait for the sentiment to change in line with that fundamental outlook, and then you have a much better price to sell or to buy from. Okay, I think the Q&A is, we've gone through Q&A as well. We have one from Armand here. Armand saying, I was looking at the funded trading programs and came across this review, which you found quite helpful. It's one for the FTMO and a couple of others as well. It's on YouTube. Okay, awesome. Thanks for that, Armand. For the guys that's interested, make sure to check out YouTube. Is there a name for that video, Armand? For some reason, I can't copy from the chat from last week. If there's a name, that'll be awesome. So let me just quickly pop over to YouTube and see if there's any other questions here as well. Do we look at the COT report? We do. It is one of our, it's part of our analysis. We do have a weekly COT currency report that we look at, but you know, it's just one part of our analysis, right? So it's very helpful to use COT data to see where the market is positioned, especially if we think there is an extreme position. If we think the market is maybe priced incorrectly for a particular currency, that can provide some great opportunities. COT was very helpful for the most recent equity run that we had. So if we quickly take a look at the S&P on the daily, for example, we've just had a massive rally to the upside in the midst of this slowdown. There we go. So we had this massive rally, and we also know that from about that area, from about that time, we had a massive net short position on the S&P. So the S&P upside has been a very, very, very big pain trade for a lot of traders that were short on the S&P following that market crash. So COT can be helpful, especially from the shorter point of view, also medium term. But I'll stress that it's really just it's one part of the analysis. So I'll never take a trade just because COT data says, you know, it's there's a big short position or a big long position. It's always just one part of the overall analysis, so to speak. Okay, Armand saying the name of the video is "Should You Join These Funded Trading Programs?" Okay, awesome, and that's on YouTube, so you guys can just search for that, and then see if you guys can catch that one. Let me just quickly check over the questions. Okay, we have a question from Angel. USD CAD still valid. Oil is in red right now. Okay, let's quickly take a look. It looks like the Ozzy and the Kiwi is still moving up. Let's take a look at the USD CAD. Oil markets is moving lower. What I'll say on this one, Angel, let's quickly take a look and see what equity markets are doing. So equity markets have also seen a little bit of a pullback. Nothing major right now, but it is off the highs. Let's quickly take a look at yields, just to make sure we are still looking at a risk on environment. We can see yields are still up on the day. Commodity space, copper still moving up, silver still supported, platinum as well, gold still moving sideways. So oil is moving down. Let's see if there's a particular catalyst for oil moving down right now. I'm not seeing anything in the feed particularly that might be moving it lower. The one thing that I will say, even though we are still seeing that risk on tone, again, there's no particular catalyst driving risk on tone right now. We can see CAD is taking a beating on the back of that move to the downside in oil prices. So how I would look at the USD CAD, if we see oil prices, if we see WTI as well as Brent crude, if we see it crack below our session lows, I would definitely not look to get involved in the USD CAD in today's session. If we see it crack below, take out the session lows on WTI, that comes in at 18.49 on this broker. And for Brent crude coming in at 27.95, if we see it crack below, I will definitely hold off on a potential short on the USD CAD for today. So just keep a very close eye on oil prices. Also, keep a close eye later in today's session. Of course, we have the crude oil inventories coming up. So that should be GMT 3:30, I think. So it's in 90 minutes time from now. So just watch out for that. That can also be a potential mover. But yeah, for USD CAD, the risk zone is still positive, but with oil prices moving low, if you see it crack below session lows, then don't look for any potential trade on the USD CAD. I'll actually do just a quick video on that one after this. Okay, guys, it looks like we've gone through all of our questions on the Q&A as well as the chat. I've also gone through the questions on the live stream. So that is that from my side. For the session today, again, make sure to watch the risk tone very carefully. That is the main driver in the session today. Make sure to watch for any particular catalyst coming out. Right now, there's no major drivers for that risk on tone, so it can change very quickly. So make sure that you're staying nimble. Don't over leverage on any of these trades. They are just normal day trades. So make sure that you keep your risk low. Make sure to check out the BOE event coming up tomorrow. That is going to be a big one. I think we can see some potential moves from the pound either way. So make sure to catch up on the daily risk event outlook report for more information on what we're looking for exactly for the BOE event tomorrow. And then that is everything from my side, guys. Tomorrow you will have Giles in the room. And then on Friday, you will have Dan. So I'll only be seeing you guys again on Monday for the webinar session. So I hope you guys have a great trading week, great trading day, great weekend. And then I'll catch everybody again on Monday. Thanks, guys. Take care.